I'm Keith McCullough, and thanks for joining us for this special edition of Bubbles and Crashes. There's not very often you can have a call like this, and I thank my friend Daniel Lacalle for spending and scheduling the time. I guess, Daniel, this wouldn't entirely be a surprise to you or I. The preconditions pre-virus, which I want to spend a lot of time on economically, pre-virus conditions, I can't say that enough times, but preconditioning markets to crash obviously happens. You and I wouldn't schedule a call like this if we didn't think that the probability was rising that it could happen. And I think that that's a big thing. You and I both have been at major hedge funds, obviously. Now I call it Hedgeye. And we are where we are, which is, for many hedge funds, indeed those that are levered long, they're getting the old tap on the shoulder right now and forced to sell at the lows. So there's a lot to talk about here, man. You've been there before. I think that that's the most important thing. And you've certainly had the right economic outlook, which is the other big thing. So maybe just start with that. And also, we're also just coming off the switch on the ECB meeting. In the top 3 people in the world, I think you would be on that list on who should make comments as to what they just did and what it means. So if you want to start with that or wherever you want to start, I'm game.
Great. Well, thank you very much for having me. Always a pleasure to be here discussing about macroeconomics and what's happening in monetary policy. And I think that the key thing to start with is that the slowdown of the Eurozone, the slowdown of the global economy was already quite evident last year. I think that the big mistake that we can make as investors or as analysts is to blame everything on the coronavirus and forget that fourth quarter GDP of Japan was -6% and that France, Italy were already in stagnation, Germany on the verge of recession. So that's an important factor. The second is what we have seen today is policy response. Policy response is completely misguided. The idea from central banks that cutting rates after having ultra low rates is going to make a difference is, it's completely nonsensical. But from the perspective of the ECB, what they have just done, announce a 120 billion repurchase program, well, again, they're just doing more of what they have been doing for the past years with very little effect. What is going to happen? We're going to see further negative.
I think we're having a technical difficulty here, are we, guys? Yeah, just there we are for a second. That actually might be the most obvious pregnant pause you've ever seen when a market should be having it, by the way. We're going to get Daniel right back here, I think, guys. Can you just give me a hand signal when that comes back? As I learned when I spent a little bit of time on the old wall TV and then just couldn't handle it anymore and had to leave. You just tell people what's going on when you have a moment like that. We're having a moment like that in the market, and maybe that's, God willing, maybe that's the message here. I should be talking about that. There's an epic moment going on here in the stock market. Don't forget that this is the second time out that we've given to adults, obviously, that had no risk management process whatsoever. People that didn't do macro and they just did stock picking, obviously that's going to be a problem for their clients today. I guess on Wall Street, some people, the art of managing money is not managing your own. So it's okay sometimes to tell yourself things like 0% profit growth and a deceleration in economic growth, which we clearly had, by the way, that accelerated at a faster pace in Q3 of last year in the U.S., don't forget. As Daniel was just outlining, we've had a slowdown in global economic growth that started back in Q1 of 2018. So what could possibly go wrong? Global growth was slowing, U.S. growth was slowing, corporate profits growth slowed to negative, and you have a bunch of people running around with their hair on fire telling you to buy stocks and corporate credit. Now, corporate credit's a big thing that's going on right now. I'm short corporate credit, full disclosure, and haven't been able to trade around it, by the way, because as of today, they've basically eliminated the borrow. In other words, you can't put the short back on if you trade around the position. So I'm just riding it. I'm going to ride junk bonds right to the thralls of the low of the cycle. There's a lot out there that a lot of people haven't had to trade through before or risk manage. So don't forget that. There's an entire credit trade going on. If you're wondering why all of Wall Street's major bankers flew privately to meet with Trump in the Oval Office with no notice yesterday, maybe a little bit of notice, it's because it's a shit show. Okay, credit is a shit show. That's not a technical term. That's a realistic term. So when you get to where we're at today on that, just don't forget that bankers don't just show up, bended with bended knee and hands out for bailouts unless they know they're going to need them. All right. So and that's the other big thing. I think we got Daniel back. Do we have him back on there?
I'm sorry. I don't know what happened.
Well, I think that the market gods just gave me an opportunity to tell them what's going on from my perspective in credit. So again, it's kind of this heart-stopping moment, Daniel, for people in markets. For you and I, of course, not. I think this is both, not to date us, but this is our third cycle, is it not? Third major stock market crash in the U.S. that came at a full and proper, full-stop economic cycle peak in the U.S. For that matter. As you were just going to allude to, I'm sure, the European quote-unquote recovery was tepid at best. But maybe just to the point that you were just alluding to, which is the expectation that liquidity and cowbell, your point is that that's precisely the wrong thing to do right now at this level of negative interest rates. Why?
Well, it's pretty evident. What we are seeing right now is not a demand problem. There is no output gap in most of the countries that are injecting massively into the economy, that are injecting masses of liquidity, that are lowering rates. There's very little output gap. Even in countries like Germany, there is very little output gap, and it's widely been shown. So I think that the big problem here is that central banks and the governments are looking at the problems of the economy from the wrong perspective. They see low growth, low productivity, and they don't blame it on monetary policy or on stagnation leading government policies. They blame it on lack of demand and excess savings. There's none of those. They're ignoring one thing that you and I have been talking about numerous times, which is demographics. The other thing that they ignore is technology. And the third thing that they ignore is the transfer of wealth from the productive sectors into the unproductive that they have been creating for years. So you don't solve a supply problem, a supply shock like what we are seeing right now with more demand side policies. Because what you create is a double negative. On one side, you will see that there will be a demand crunch for many of the companies that are investing right now. And on the other side, what you will see is that there will be an increase in oversupply in the sectors that benefit from increase of money supply and low rates, which are actually the ones that are already in overcapacity. Right.
Now people don't understand tipping points unless they understand rates of change. Now, tipping points come at a certain time in a cycle, but they also come within a secular picture. So for those of you that don't know, secular is longer term and the cycle is cyclical, right? So we have, like, as Daniel and I have outlined for a long period of time, you have demographic headwinds that are secular. And then you have cyclical recoveries and you have cyclical slowdowns within secular damnation. Now, central banks have for a long time figured out that they could resuscitate asset prices, but only to a point. This is the other important point. Going back across our careers, Daniel, and you and I have been on the right side of the prior two crashes. Not a lot of people have. I mean, it's kind of a weird thing, I guess, is to just actually call when the cycle's slowing at a faster rate. But again, you and I don't have to go back and apologize for the calls we make in 08 or now for that matter. Why is it that when the Federal Reserve, just to take it there, you've already addressed the ECB, why is it that when they go to first of all, when they go to the first rate cut after their hawkish, which was nonsensical in Q4 of 2018, obviously the market's going to like that from a lower point. But then once they get into the first, second, third rate cut, yeah, okay, market's kind of like that too. But why is it that once they get into the fourth, the fifth, the sixth, the bazooka, like why is it that markets don't like the cowbell at that point?
To me, there's three reasons. The first one is that monetary easing starts to show weakness instead of strength. You see, when people perceive that the economy is slowing down because of a demand problem, and therefore they see that a rate cut is going to generate an improvement in some form, then there is a logic that creates some level of expectation from markets. But there's a point at which, one, monetary policy becomes the norm, and easing has already shown diminishing returns. It's always already showing diminishing returns already. So when you see the next rate cut, it becomes less than a sign of strength, a sign of weakness. The second, in my opinion as well, is that when the Fed makes a drastic rate cut, that is unjustified by the messages that the Fed itself gives, it creates panic. You just have to read the minutes. You read what they say. They say that the economy is strong, that inflation is at 2.5%, that unemployment is at its lowest levels in 50 years, that everything is going swimmingly, and we are going to implement a 50 basis points rate cut. Something doesn't click. And investors, rightly so, take the other side, which is to believe that the Fed knows more about how bad things are than what they perceive. The third factor is the factor of comparative policies. When every single central bank is implementing the same policies, the idea that you're making something drastic is completely debunked by the reality of what the PBOC, the Central Bank of China, or the Central Bank of Japan are doing. So even when you decide to make a big headline-grabbing policy change, in reality, what you're just doing is following the path of others and generating very little additional discernible impact on the economy.
It's an amazing thing, if only because it's logical. You know, and it's you have to go back to almost Aristotle to just to think of the logic of it all. Yeah, I walked 10,000 feet and I realized the world wasn't flat. I mean, the curvature, rates of change, and pushing on a string. These are all things that, interestingly but not ironically, as you well know, have been very obvious to mathematicians, physicists, anybody who's scientific, actually, as opposed to qualitative in their approach for a long, long time. What I find is that we get a lot of narratives. There are a lot of narratives on how liquidity is the answer to the world's problems, and they're generally buy-side narratives, buy-siders running money that have a certain kind of a strategy, are they not? Like, that's the problem. I wonder if, and this time, Daniel, I have to tell you, man, I don't know if you hear this or see this as well amongst people that you speak to, but today's modern hedge fund is not one that's managing risk. They're looking for the next level of liquidity. They are largely, whether they're credit investors, their credit hedge fund is basically a levered long credit fund. Let's be clear with that. Or hedge funds that are just like pretty much either neutral or grossly exposed to the market, one or the other. But they don't fundamentally believe that this thing can actually go down the way it's been going down for the last couple of weeks.
Well, I completely agree. Many hedge funds, the vast majority of the hedge fund industry has become long onlys with shorts, and very exposed to the cycle. The years in which we had to endure risk factor adjustments every Thursday, in which you had to be beta neutral, market neutral, currency neutral, country neutral, sector neutral. Yeah, I remember. I mean, I was thinking the other day of my ex-colleagues at Citadel, and it was absolutely impossible to reach the levels of beta exposure and market exposure and trend exposure that many funds are following right now. And that is and what we are seeing in this crash is unbelievable, because one thing that we saw in the weeks before the crash was that exposure to the markets and net long exposure of hedge funds actually increased in an all-time high. So, it's an interesting. We live in interesting times, but this has been led and fed by central bank policy and repeating over and over that you cannot fight against the Fed. Well, you can't.
Well, once you get into economic quad 4, okay, quad 4, just so people that don't know, now you're going to know. It's when the prevailing rate of change of growth and inflation slows at the same time. And what Daniel's saying is that the central bank comes in and tries to stop the inflation part from slowing, because that's called deflation or disinflation or both, and they can't. So if they can't, the machine turns around and sees more quad 4. And when you look at quad 4 from a factor exposure perspective, maybe, Josephine, you could pop that up, just because Daniel just said a bunch of words that actually mean a lot mathematically, and that doesn't surprise me. For those of you that have run money at the highest level in the modern era, the machine cares about factor exposures like high beta, momentum. Actually, secular growers are a short in quad 4 because they pick up cyclical realities. Okay, so these high beta, Daniel, that's why I said the other day, I mean, when I saw the Fed cut by 50 basis points, and the market reaction, which was obviously negative. What I was really looking at was the high beta factor exposure, small cap factor exposure, high short interest, all the things that should be going up if the market actually believed the cowbell. Conversely, you can see that we're showing all that data, but you already know what it is. I mean, high beta yesterday, before what you see on your screen today, was down 7.1% on the day. It's down 32% in a month, right? So I think people have a very loose understanding, because if only they're watching old wall TV and reading whatever, old wall journals and everything else, they don't actually know how a modern day risk manager at one of these massive hedge funds is actually tasked with doing their job. Like these, the factors, when the factors crash, the whole thing crashes. That's I don't know how the Fed gets it out of that. Like, what are they going to do if the crashing factors, high beta, small cap, leverage, and the credit cycle, like how is the Fed actually going to resuscitate those factors to the point that not a human believes it, but the machine believes it? The 85% of daily trading that's on your screen, or 90 right now, when markets are actually finding the real illiquidity. Like, how does the Fed change the setup of that component of the market, the machine? Like, I'm setting aside all the human opinions of that.
Yeah, well, I think it's extremely difficult for the Fed to take action on that, because it is the facilitator and it's actually been creating that exposure. It is actually the one that has been telling everybody to be more exposed to the cycle. Now, from the Federal Reserve perspective, there are some factors that they take into account when looking at monetary policy that don't reach the headlines very quickly, which is that one of them, or at all, one of them that I think is very, very important and that very few people talk about is that they always look at what is the demand for dollars compared to the supply of dollars. This is something that other central banks don't do. Other central banks simply increase liquidity and hope for the best. And I think that is why what is happening right now is so important, is that what we are starting to see is that the credit mechanism and the monetary policy mechanism, the mechanism of transmission of monetary policy has been so broken that a rate cut or a change in policy that is inconsistent with the messages that the same policymaker is giving about the economy create a double negative. And that's back to your point. At the beginning of an expansionary monetary policy, hope and faith are the key factors.
Yep.
You in 2009, you pump a lot of liquidity and you say, look, things cannot go any worse, so they will get better. Let's go and buy cyclical assets. That makes sense.
Yep.
But once you're into the first, not the fifth, the sixth, the seventh, the 10th year, and you have exhausted all monetary policy options in an environment in which there was growth, then what happens is exactly what you just said, is that it works like a boomerang. It goes against you very, very quickly. But and the central bank that has become the enabler of bubbles is actually even worse, even impacting the burst of those bubbles even more by taking expansionary policies, because if you've lost the hope and the faith that those actions are going to make a meaningful impact on the real economy, then it's simply just insane policies. That's the problem. Yeah. Remember, you just mentioned the different stages. This is very important. Remember when the Fed easing policy was always in line with the messages that they gave about the economy. So they said, look, the economy is weak. We are seeing strengthening parts here. We are seeing some, the labor market is still weak, blah, 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 all these things. So this justifies easing. But if you say month after month after month after month in the last 2 years that everything is great, and at the same time, you cut rates and you increase the balance sheet, saying that it's not QE when it's QE all over the place, exactly. then it's counterproductive. And and I think that there are numerous papers out there saying that monetary policy is in monetary policy, communication is as important as the policy itself. Well, I wouldn't agree with that, but I would say that if you believe in that, then you're making the biggest communication mistake ever by saying that everything is great and we're going to cut rates, which is the problem of the ECB as well. The ECB has been talking about recovery, industrial production down, manufacturing sector in contraction, growth in Germany, France, Italy, etc. slowing down. And now you do something that people just don't believe in because they know that that is exactly what you've been doing in the past 2 years.
Yeah, I mean, it was very convenient for Wall Street to park all those industrial cyclical realities in a parking lot over there and say, I'm long the secular growers over here. It's like God called and gave you a bunch of companies that were going to never show any cyclicality, irrespective of any shock. Now, this is where you can get a bee in your bonnet, because if you go back and you actually study the fact of the matter, and I do think that there are similarities to the market follow through both and like to 2001. I mean, the 9/11 shock was a shock that not a lot of people saw coming. Not a lot of people saw the virus coming, but more people didn't see the slowdown coming before the shock, and that's the main point. Like, it's just like measuring and mapping the conditional factors or the emergent properties in a pending avalanche. Now, you may not notice what a Sherpa at the bottom of the mountain naturally is hearing and seeing that's different this time, but clearly those of us that are measuring and mapping economies could see the deterioration, particularly in the fourth quarter. And there was a real want to believe that the Trump trade war ending, first of all, that we'd only slowed, by the way, because of the trade war, which is complete bullshit, and that it was going to be up and away from there. The problem is that all those assumptions are now only going to go straight down from there. And that's the problem people have, is that they have their industrial cyclical manufacturing global recession, and their secular growers are showing some cyclical realities that may very much look like the back half of 2001.
Yeah. Yes, multiple expansion has been the driver of equity markets for a long time. And that multiple expansion was based on two factors. First, I think that everyone that's watching right now has heard this before. In June, everything goes up. ISMs, PMIs, everything is going to recover in June. The second one is that the CapEx cycle, which has been deteriorating for 5 years now, if I'm not wrong, 5 years of no growth in CapEx. You cannot expect cyclical recovery if there's no growth in CapEx. More importantly, you cannot expect cyclical recovery if, with no growth in CapEx, you have massive growth in current spending, because it is deflationary, and it goes against productivity growth. So the fact that we saw that so many decided to ignore all these factors based on the idea that central bank policy would end up working at some point has created this accumulation of risk that then suddenly, because of one event, and I call it the coronavirus card, everything bursts. But we already saw the use of the trade war card that you mentioned, and we already saw the use of the Brexit card to justify what were secular problems.
Right. I mean, and to justify the positioning of the market at the all-time highs. At the all-time highs. I can't say that enough times. The Federal Reserve is going to cut by 75 or 100 basis points and push on one mother of a string next week after the stock market hit an all-time high on February the 19th. I mean, this is epic in terms of Wall Street's inability to be positioned for the right thing at the right time. Look at this. You can't see this, but I'll just rattle it off to you. This was Wall Street's positioning, slide 74, guys, in the macro deck. This is futures and options positioning, non-commercial, Daniel. I'm sure you pay a lot of attention to it. But coming into this, Wall Street was basically short the dollar, short treasuries across the curve in size, long oil, and small cap stocks. Yeah. Like, so there's a couple things there, right? I mean, it's one thing to get the cycle right, but when you get the cycle right at the turn, and what I'd affectionately call old Wall Street, and which is now the new consensus is the hedge fund community, is on the other side of that, you have the perfect setup for effectively a crash. I mean, it's not. I don't know how people miss that, or by the way, how would you come into a position like this, short treasuries? That's a question I have for you, because I get a lot of pushback on this, and I think it's kind of bananas. I mean, it's mostly people that only do stocks, but because obviously if you've seen where JGB yields or Bund yields or Swiss 10-year yields gone, you know that yields can go lower. But I get a lot of people in the U.S. in particular that say, well, how much lower can bond yields go? I mean, yeah, in the U.S. because they've gone straight down to all-time lows, and I am curious as to how you answer that question, given a lot more people are going to need the answer.
I just cannot understand how anybody that has read monetary history believes that the world's reserve currency is going to weaken in an environment in which the non-world reserve currencies are doing all the mistakes that fiat currency central banks do, but without being the world reserve currency. I just don't understand this. Okay. And you've had numerous analysis showing that global dollar-denominated debt rose to all-time highs in the last 5 years. You have also the massive maturities, which means buying of dollars. You also have the weakening of the capex and the weakening of the industrial and manufacturing sector, and an economy that in general is being saved by the services sector. You have the Central Bank in Europe, the Central Bank of Japan, the Bank of England, the PBOC, everybody easing massively, including the weakest currencies in the world, and yet you would expect then to that the dollar would weaken. It makes no sense to me. It only makes sense if you believe that there is going to be a swift change in market mentality about the safety of an asset. That is, that because it's expensive or relatively expensive, be it the German bond, US treasuries, the dollar, people simply will find the next best option and go massively long that. Right. That never happens. That never happens. And the reason why it doesn't happen is because this is a world of relatives. Yes, the German bond is expensive, but tell me one thing. If there is a redenomination risk in the Eurozone, if there is a problem in the Eurozone, what do you want to hold? Minus 0.2, I don't remember where it is right now, minus negative bonds in Germany or negative yielding bonds in Spain? Somebody has to tell me that. Because it's a game of relatives, and you cannot expect the dollar to weaken because bond yields in the US are low, because bond yields relative to the risk that you're taking in so many other countries are much lower. Let me give you a case in point. The 100-year Argentine bond, 7.5% yield. Okay, a country that defaulted 8 times in its history and it's on its way to the 9th. 7.5% yield. What is more expensive? The 10-year treasury at I don't care, at 0 or that at 7.5%? That one at 7.5%. You see, this is what we fail to understand the amount of risk that we're taking. For example, if we buy Portuguese or Italian bonds at these levels relative to what we're taking with the United States. And of course, the United States has its issues, deficit, growth slowdown, high debt, of course. But it's a game of relatives. It is a game of relatives.
Well, it's who loses the least amount of money when everybody's losing all theirs. I mean, I don't think people get that unless they've won the game before. I mean, we have, and we're winning this one by basically doing just that. The dollar's actually up a full % right now on the U.S. dollar index, which shouldn't surprise people given the amount of panic out there. And again, panic's not a process, to be clear. So for those of you that are learning that for the first time, it's important to learn from your mistakes. We're going to take some questions here, Daniel. For those of you that don't know the Hedgeye process here, your questions are actually going to be graded by your peers in the queue. So I'm going to ask the questions that are graded, for Daniel in particular, best. So please pop them in there. The first one actually it has to do with liquidity here, Daniel. It's an interesting question, but I'll get it a lot today. In fact, I have a big institutional client call at 11 o'clock, so I'm going to have to cut this off in about 20 minutes, but I'm sure they're going to focus on this. The question is, do you think a liquidity problem is possible in the coming days or today? What would that imply? Were we about to see an event similar to '08 from a liquidity perspective, or is that just a different ball game?
I think it's a different ball game. I don't think we will see a liquidity problem like we saw in '08. Because this is not an issue of banks running out of liquidity. This is going to be an issue of asset prices and mark to market of the balance sheet and the assets in the bank's balance sheets. So those banks will receive liquidity, as we are seeing every day with the repo crisis, and we are seeing every day also in Europe, will receive liquidity. The problem is going to be double. As on one side, those banks are going to refinance zombie debt, are going to refinance existing assets so that it doesn't hurt them more. But it's going to be virtually impossible to get credit for working capital and for new investments for the high productivity sectors. So on one side, you zombify what exists in your balance sheet, be it in the central bank or be it at the commercial banks, and on the other hand, there's a credit crunch in the SME and in the working capital build of the more cyclical sectors.
Mm-hmm. Good answer. All right, this question, I'll take a crack at it too, and I want to hear your answer as well, Daniel. With this level of volatility in equities, all sectors are being sold. Any comment on which sectors or factor exposures recover first? Now, this is actually right to the point that Daniel and I were addressing, which is it's what factors you don't want to own first that go down the fastest. Well, those aren't the ones to own. They might be good for a one-day bounce, but they're the first things you should sell when they bounce, and that's the whole point. We've had 3 big bounces in these factor exposures in the last 2 weeks, and you should have sold all of them. But what the market actually looks for is the opposite of those factors. So if you pull up those factor exposures, you can see if you have a portfolio of stocks, what you should be really doing is being in the names that have the lowest betas, with the quality as a style factor is basically a view of the balance sheet, low debt to enterprise value, and safe yields as opposed to speculative and levered yields. But again, it takes a little while, and this, Daniel, I want to definitely get your view on this. I made the comment right after the Fed meeting that a breakout, or what I call a phase transition in the VIX, just to make it simple, that kind of a breakout in volatility is a phase transition that actually makes most equities, whether it's a gold miner or a utility, which are things that I could like in a different volatility scenario, I said they made them uninvestable. Not uninvestable forever, like not Warren Buffett uninvestable, but uninvestable for the period of time that you're willing to take on the risk. And that's really, that's what I mean by that. Like, how do you think about, like today, front month VIX or equity vols, it hits 70. I mean, there aren't many times looking back to 1986 that in fact, there are only 3 times, 2008, 1987, and now. What is it, do things become uninvestable? And are certain factor exposures uninvestable until that vol starts to tone down?
Absolutely. I agree with you. I think that there are certain risk factors that you need to take into account. The most important being currency factor. The other factor that I think is very important is the inflation link factor, because if we're moving into a deflationary environment, you're going to fall very quickly into the value trap as an opportunity, and those are the ones that will get hit the most, even despite allegedly cheap multiples. No, so there are many things that become uninvestable in this environment. But what I do think is that what is important is that if what you're actively looking to do, obviously, is to look for opportunities. The biggest mistake that we can make right now, and we all fall into that mistake from time to time, but we learn from our mistakes, is to buy the value traps. Those stocks that look cheap, were cheap, are going to be cheap, are always cheap, and they never go up. So They don't protect you. This is a key factor. What are we learning from this environment that we're seeing right now? Those stocks don't protect you in the downside, and they don't make you money on the upside. So they're empty calories. That's what I would say to avoid.
Well, I mean, to educate people on what is a cheap stock is something that could take down CNBC forever. I mean, cheap means nothing if you're talking about the wrong numbers. Let's just start there. Cheap gets cheaper, or one of the greatest on the way down. And one of the greatest value investors of all time, Marty Whitman, would say a bargain that remains a bargain is no bargain. Like, there are a lot of different ways to learn on the job here when it comes to what is a cheap stock. If it's got a lot of leverage and it's got a fake yield, I mean, that's a stock that needs to be unloaded by the machine first, and then it forces the active manager to sell it next. Don't forget that there's a lot to this that has nothing to do with the active manager. It has to do with all the passive flows in the machine itself. So that's important. Here's the next question. You've written a book on this. This is actually, this is perfect. This is like the biggest softball I could throw at Daniel Lacalle all the way to Spain from Stamford, Connecticut. Like, who? This is a great question. Who is going to bail out the central banks?
Oh, you and I. The person that has made the question and I. We're going to do it. We're going to, debt is always repaid. Thanks for the question. I'm not going to spend an hour because we don't have no time.
You could, though. You could do a whole seminar on the answer to this question.
Absolutely. Oh, we are going to pay. We are going to pay either in stagflation, which is very detrimental to the average real salary and the average wealth of normal citizens, or with a crisis. Hopefully, as I say in my book, Escape from the Central Bank Trap, hopefully what we would get out of this is a Japan-style stagnation. Believe me, this would be the positive, because if this goes crazy into a monetary bust, then it would be very bad. But who pays for central bank insanity? Citizens, always. Always.
Yeah, always. I mean, and if you haven't read it, you absolutely have to read Escape from the Central Bank Trap. The guy wrote it. I mean, he wrote it before you asked the question. That's called being proactively predictive here. But again, I don't think people understand that, and this is the main problem like that I had yesterday with all these bankers sitting there, kind of, that really pissed me off. I don't know about other people, but I mean, to say that everything's cool when it's not, and they're just prepping to be that round table of people that are allegedly going to save us from ourselves again. No. The people paid the bill. Dick Fuld didn't pay the bill. Dick Fuld paid a reputational price that was different than some of the other bankers, but we paid the bill. So again, that's the point. The people have been pulverized. It's genuinely, absolutely. It's obviously perpetuated the inequality gaps that have now become the political topic du jour, and it should be. I mean, it's like, okay, asset prices go up and the people pay the bill. I mean, in this case, actually, the bigger question is what happens when the asset prices only go down and the people are still paying the bill. You got both things going on there. Rich people are actually going to feel this one too, are they not?
Oh, they will, absolutely, because rich people are the most indebted. That we need to remember that. Many times when people talk about massive wealth, they also tend to forget how much debt is within that wealth. But what happens usually in this environment is that after the market crashes, you have an L-shaped recovery in asset prices. And what happens in an L-shaped recovery in asset prices is that it's extremely negative for almost everyone that's levered to central bank policy, because you see sort of small increases and falls, etc. And if you have that sort of L-shaped recovery, then the indebted bet on the cycle becomes destruction of money on the future. I don't know if you pick this up. Basically what is happening is that you have consumed the net present value of your debt very quickly up front, and then you have a very long time of destruction of money. So even if you get money supply growth, actually money velocity, not just which was already falling, collapses.
Yep. Well, now on that, I'm going to ring fence a bunch of questions on this topic because it genuinely, people, that are gold bugs, for example. This is, I'm not a gold bug. I'm a bull bear on gold, depending on what the risk management setup is telling me. So they can't believe the gold's down here today. I mean, they probably can't believe that the dollar's up today either. But guess what? Get used to it. That's actually what happened, and maybe so that you can kind of go through that if you have, if you want to do it. But gold goes up to a point in '08 and then goes down too. I mean, dollars went straight up. So can you explain the role of the world's reserve currency? And by the way, gold, for those of you that don't pay for what we do, all it just did was it went to the low end of its risk range. If you're the idiot who bought it at the top end of the range because you chase charts, you deserve to lose money. So things do correct within the risk range, which include bond yields, which include gold, which include anything. So that's partly what's going on here, is that people chased it at precisely the wrong time. Now they're forced sellers. The liquidity part of the trade, though, I think, Daniel, is what a lot of people are interested in, where people have to sell their winners to fund their liquidity problems.
That is it. That is it. That is what we're seeing. First, that is the reason why the dollar sold off in a couple of weeks ago. You basically had a massive bet that you're unwinding. So one of your hedges, which is to be long dollar assets, is coming down. Okay. So what we're seeing right now with gold is pretty similar. The idea of having gold as an uncorrelated hedge to the cycle makes sense, but there's a point at which also, like in 2008, the safest asset becomes the dollar, because it is the world reserve currency. We might dislike what the Fed is doing. We might find it not incorrect, but it is a reality. It is a reality, and the world today, 2020, is more dollarized than it was in 2008, particularly China. Big mistake that we hear out there. China is going to destroy the monetary system and is going to be the new world reserve currency, and everything is going to be different. No, because China is doing the same mistakes as the Fed, but with capital controls. So what can you expect? No, not the same mistakes.
And their developing deficit is funded in U.S. dollar-denominated debt. I mean, so
exactly.
I can't explain it enough times. I mean, tell me if this is too simple for people. If you need to sell a bunch of shit in dollars, the dollars go up when you sell the other stuff. So today, again, the dollar is one of the best places to have your money when the shit really hits the fan. And apologies for using that word, not really. That's what's actually happening today. So I mean, the other thing, like people, is it not the same thing with Bitcoin? Bitcoin actually hasn't been tried in a 1987 or an '08, by the way, and it's getting its ass kicked right now in dollars.
Yeah. Well, the Bitcoin, if you believe that fiat currencies are fundamentally flawed and they're going to fall down, you need to understand that Bitcoin is a startup currency. It is not a currency. It's not widely used. It's not a reserve of value. And I would encourage everyone that's long Bitcoin and cryptocurrencies to understand that the volatility that you're going to take is absolutely immense. And there's a book that Friedrich von Hayek wrote before the internet even existed, which was the denationalization of money, in which he explained that the rise in non-central bank, non-government fiat currencies would end up with very few of them actually surviving, no? And this is something that we need to take into account. So cryptocurrencies are basically like investing in biotechnology. Extremely volatile, very risky bets, and obviously not yet a currency. I'm not saying that it might be sometime. It is not now. So in terms of turmoil, it doesn't help you.
Well, I think that's like one of the biggest misnomers in all of the perma-marketing of assets. Okay, let's just say, and I don't really think we have time to get into debate as to whether or not it's a startup currency or a shitty commodity. We can call it, when it's down, it looks like, to me, it looks like a shitty commodity with a lot of volatility. When it's up, it looks like, okay, maybe we'll call it a startup currency if it has low volatility. But the common word in all of those things that I just said is volatility. It is like anything else. Cocoa futures or cattle futures, for that matter, trades with volatility. So, I mean, the amount of volatility you've had to take on to be a buy and hold resident of the Bitcoin community is epic. I mean, it's bananas. Now, let's just table that. I got a bunch of questions too, and maybe this will be one of the last ones because this is another area of your expertise. If you didn't know, when Daniel was on the buy side at Citadel, he was long short energy was a big focus of his. Is an area of expertise. He's written books on this, obviously. But on the topic of volatility, oil volatility today is at 110. I mean, of all the things you've seen in oil, we haven't seen that. Like, we've seen like 80, 90 vol. I mean, when you're talking vol, I'm talking about like the equivalent level of volatility. Like if you're just looking at the VIX right here at 60 or 70, which has only happened twice in U.S. history. 110?
Yeah. Crazy, isn't it?
Like, what the hell?
Yeah. Well, look at the curve. Look at the curve. It's unbelievable. It is really unbelievable. What we're seeing is, well, it's a big combination. It's a combination of numerous factors. What is happening in oil right now? No, obviously it's easy to blame it all on the disputes between Saudi Arabia and Russia. Let's be fairly honest. Those two together mean less than 20% of the market, so they're not the drivers of volatility. The reason why there's such high volatility is coming back to the chart that you mentioned before. Is how leveraged the bets on oil were into the headline-grabbing views about U.S.-Iran tensions, Saudi Arabia drone attacks, etc., which was missing what was happening in the freight sector, what was happening also from the supply side, and to that. Now we have a demand problem, so everything is going crazy, no?
Yeah, I mean, crazy is as crazy does. You know, I mean, this is the history of markets. If you go beyond your years and what's in between those years, you're going to find there's a lot of this, and there have been a lot of bubbles. And that's really my last question. It's more mine, selfishly. No offense to the Q&A, but. Looking back, you know, I think everything from tulips to Tesla, the bubble is plainly obvious looking backwards. Do you think, I have my own answer to this, which I will not disclose to those of you that don't know the answer. There's a hint. But do you think that what we just saw between really February the 14th and the 19th of 2020 was indeed the top of a U.S. stock market bubble?
Probably yes, I think so. I think that probably we have. I would call more than. I would say that more the idea of the entire stock market. Definitely, you had a very abrupt increase in valuations from different parts of the economy that we're seeing actually the disruption of technology that did not make any sense, no? But what I would think is it possible to, this is the point, is it possible to get it back to bubble or elevated valuation territory? Absolutely it can. Is it easy short term? No way.
Yeah, that's the answer, guys and gals. If you don't like it, then I guess it's too bad. The market's going to keep ticking here. And as I always say, like, your next move's the most important move. So I think you've given a lot of people a lot to think about. We'll see if they get another time out with the stock market, having already had one today. But again, thanks for doing all the contextual work, all the books, Daniel. Everything I can ask you anything you've actually written a book on it, never mind had the right call coming into this. And I think a lot of people and a lot more people are going to start to read your stuff, follow you. Obviously, you're very active on Twitter, and the world should thank you. The investing world should thank you for that.
Thank you so much. It's always a pleasure. Always great to chat. Always
all right.
Great chat.
Good to see you. Good to see you.
Have a good day.
All right. He's Daniel Lacalle. You can find him on Twitter. You can find me too. We're going to go back to that in my own personal accounts right now. Thanks.